Hello, everyone, and welcome to At Barrons. I'm Andy Serwer, and welcome to our guest, Brian Moynihan, CEO of Bank of America. Brian, great to see you. Thanks for joining us.
That's great to be here again.
So I want to ask you about U.S. debt being downgraded. Is that deserved, warranted? What's your take on that, Brian?
Well, you can debate warranted or not. The answer is it's done. So you had three major rating agencies. This is the last one. The first two have happened a decade plus ago. And it's done. And so does it have a big impact? No. The market sort of shrugged it off. But there are technical impacts. There are certain investors are restricted only to AAA securities, even if it's a U.S. Treasury. Others are just restricted to U.S. Treasuries. And so all that will work through the system and be a little bit of resettling. But it caused the largest banks to be downgraded a notch because we can't be rated higher than the country. But, it's all worked through the system. But it's not the downgrade, it's what the representation of downgrade. And that's the question of, will we get our eyes and our stomach aligned as a country where our revenue and our expenses get more in line? And that's what the rating agencies are reflecting on. We have a tremendous country with the prospects no one else has in the world, great innovation, great capital markets, and all those good things. But at the end of the day, we're operating at substantial deficits for many years in a row now, and they're saying, can you bring that back in line so it doesn't hit the certain triggers that they would think are more problematic?
Yeah, I was going to mention the Moody's downgrade to the big banks, including yours, in wake of that, because of that, but that didn't seem to have a lot of impact. But this American exceptionalism that people are talking about sort of ending, that is a concern because you're talking about investors around the world not keeping their capital here or maybe even withdrawing, businesses not wanting to do business here. Are you seeing any evidence of that?
Not really. I mean, I think, look, at the end of the day, the uncertainty about the tax policy, will the tax bill be extended? The uncertainty about the incentives that were in the Infrastructure Act and the IRA Act, and will those be continued? Those things are momentary. But what's fundamentally strong about the United States is the rule of law, the ability to have flexible workforce, the ability to bring people in the country, even under different sets of rules over time, but the ability to have innovation, from research all the way through the process into commercialization at a level no one else has. And that capital markets capability, that innovation from pure science all the way through to a commercialization of it, those are things America's had. And then the other thing that makes America important is the final demand. At the end of the day, biggest economy in the world, 2/3 of it driven by consumer activity. That is a place that if I'm selling consumer goods of any kind in the world, or machines to make consumer goods, or whatever, I've got to think about the United States as a market, because even though other places have more population, the size of the spending and the GDP per capita is not close. So I think there'll be ebbs and flows in the views of what to do for the next 6 months, year, 2 years, but across long periods of time, America's the best place to invest.
Right. I mean, we'll talk about the American consumer a little bit. You guys have a tremendous exposure there and great visibility into that. But, some people have suggested in terms of the research, universities under threat and rule of law under threat. Are those things that concern you?
I think at the end of the day, the change in policies, deregulation, the change in policies of trying to swing the pendulum back in some areas. Those happen all the time. Those ebbs and flows go. The country's been around for 250 years, round numbers, and those ebb and flow. But we got to be careful. The basic fundamentals aren't there. The ability to operate and go through bankruptcy, that's foreign. That's different. In a lot of countries, that doesn't exist. Here it exists. That means failures fail and go on with life. The ability to get the capital markets and the registration of public companies, that's been driven by the United States, debt capital markets. So I think those fundamental principles are solid. And I think if you think about the history of the extraction of value of brains into commercial aspects, which is research at universities and national labs, those are fundamental levels. Whether there'll be more or less funding, whether it be reimbursement for overhead, all this debate. At the end of the day, I think the world agrees that we need to keep funding research. The question is exactly how to play out and what attributes will be attached to is subject to debate. But at the end of the day, there's a 100-year history of America being extremely strong and overtaking Japan, who was supposed to overtake all this because of the quality of our research capability, our ability to drive the development of computers, development of AI, development, you picked up the language, but even going back to development of plastics. At the end of the day, go back to the graduate plastics young man. Remember, that was the statement. My dad was a plastics PhD scientist and helped develop plastics. America, that's what America does. They develop things.
I didn't know that. Your dad did that?
Yeah.
They could have had your dad in that movie, or he could have been saying that to someone.
He was of the right age that was him.
Right, right. You mentioned the tax bill, Brian, and interest rates. I want to ask you about that. It's sort of a piece because The tax bill has implications for the deficit, which has implications for rates. What is your assessment on the rate environment right now? Where do you think we're going?
Well, I think our team, I think you have to start from the economic projections. So our team basically for the U.S. economy has a growth slowdown coming. It's already here from the third quarter of last year at 3% levels of GDP annualized growth to basically slightly positive in the first quarter. And they think it'll jump up a little bit in the second quarter and then go back down to the sub 1%. That's a 200 basis point drop in growth. So that's already happened because the drag on interest rates, et cetera. They don't have a recession. Then the question about inflation, so first of all, they don't have a recession, which the economy is going to continue to grow, so the Fed will not feel compelled to drop rates to to help the economy along. The second thing is unemployment strong. Their peak unemployment projections to get to about 4.5, 4.6 from where we are now in the middle of next year, which is not a high level unemployment, in a historical context. Then the third question is, will the Fed cut rates? And they have no cuts because they think inflation will remain higher than the Fed wants for an extended period of time. And their view is, as you sort through 25, the discussion about the tariffs and deficit and the budget and all those things, you get through that, what will happen is they get to the middle of next year, inflation will start to turn over just on year-over-year comparables and things like that, and then they'll cut rates pretty quickly down to a 3% Fed funds level round numbers, which puts the curve more normal, from 3 to say 4.5 on the Fed funds rate to 10-year. The curve has got to get uninverted someplace, or else it's indicative of something else going on. And I think they feel that the inflation under control was going to take a long time. We may have extended that period of time a bit by the tariff regime and some of the aspects, but we'll still get out of here by mid next year, and then they'll bring rates down.
I want to ask about your customers, commercial side first. Are you seeing any behavioral change when it comes to banking activity because of what's going on with tariffs?
So, in the end of the day, our small and medium-sized businesses, if you look at them through the end of last year and this year, their question was went from being about inflation, which was a discussion last summer to fall, to more about, can I get employees again? That was sort of an interesting question because it hadn't surfaced since the Great Resignation. That came back in. Then the tariffs have come in. And so I think given that that lack of clarity to what the planning cycle is, if a business is now are heading towards their fall planning cycle for 26 and 27, 28, if you do a 3-year plan or a 2-year plan or a 1-year plan, and they're all sitting there saying, so what are the assumptions we're going to base this on? And those differences in tariffs at maybe 10, 20% versus really high tariffs, or a difference of a shutdown of trade capacity or a supply chain, that creates a lot of uncertainty. And so people were hesitating. And so what you see is the capital investment slowed down, except for AI in certain places, but in general. That should uncork as soon as there's some clarity. And so, as I talked to people in administration and others, I said, if you get some trade deals done where our research team can figure out how to extrapolate from a deal with the UK now to what would happen in India, what might happen in Japan, what might happen and people can start to get clarity that this may be not quite the stiff, really high tariffs if people come together. Then they can start to extrapolate, and that will give people calmness. And then I think the business community will say, aha, the economic assumptions now are subject to so much variability, then I can make decisions. So their activity has slowed down, not in terms of borrowings being down. Borrowings are up a little bit, and the commercial loan growth is still solid. Their credit quality is still good. They're making money, but they're just saying, do I want to commit to X, not knowing where the consumer is going to be if these tariffs slow them down or if unemployment increases. So they're just playing that out. I think that with the clarity of the tax bill, with the clarity of some of these tariff trade deals, you'll see that clarity come through. And I think as they move to the summer, they'll feel better at whatever the scenario they're planning into, that they're more assured that that scenario might be right. Because in the end of the day, these entrepreneurs, it's their money. Right. And they have the right not to make a decision. Whereas large companies kind of have to always swim forward. Smaller companies say, well, I'll just hold up on that piece of equipment. And so you're seeing line usage kind of picked up a little bit and then flattened back out, but it's still 300 or 400 basis points as an average against pre-pandemic. And so why wouldn't it get back there? The answer is people are still trying to figure out the future.
Yeah, I mean, talking about clarity in the Trump administration, I mean, even as a CEO, I mean, you look at like Tim Cook, President Trump calls him out about manufacturing here in China. Doug McMillon, Walmart, he gets called out about raising prices. And you were at Davos, and he called you up about banking or debanking or not banking conservative groups. What was that like sitting there and having the president sort of call you out like that?
It's to be a CEO of a large company with 60, 70 million consumers, people can call you out about a lot of things over the years. You've testified in front of Congress and stuff. So at the end of the day, we bank everybody. With 70 million consumers, we're banking everybody, small businesses and businesses. We're the largest small business lender in the United States and businesses all over the world. So it wasn't a question. So it was, what I think at the end of the day, what they're trying to do is push people to make the investments in America, make the decisions about America as Bank of America. That's not a question for us. And at the end of the day, we provide great services to lots of consumers and companies across this country and plan to continue to do so.
We're talking about those 70 million consumers on that side of your business. You have a consumer survey you just put out, and it shows some slight weakness. Everyone says, "Oh, consumer's resilient. Consumer's resilient."
Yeah.
Is that still the case? The consumer's always resilient?
Yeah, I think so. If you think about what drives the consumer, so you start from, are they employed? And the answer is 4.1, 4.2% employment. Yes, they're employed. Are wages growing? The answer is yes, wages are growing. Are they growing faster than inflation? The answer is they are, and have. They just have been different timing since pre-pandemic. And then the third, are they spending their money? And then they have the fourth is they have the borrowing capacity and are they good credit quality. And so the credit quality in consumer space is as strong as it ever is. So there was this great debate that delinquencies were rising. Well, they're rising back to where they were pre-pandemic because that influx of cash into the American consumer, of course, they had nothing to spend the money on for a while, so they paid down their debt and they got in better economic shape. That happened, and then it came back to normal. But the delinquencies have tipped back down and are sort of flattened out at the level they were in 19. And by the way, 19 was like a 50-year good period in our company's history, so it's very strong. Then you go to their spending. Through the month, in the first couple weeks of May, they've spent 5% more than they spent the first couple weeks of May last year in terms of money in the economy. And so when you look at it in the aggregate, about $1.7 trillion has moved from our consumer accounts into the economy over the first, since year to date through May 15th or so, say. That's up about 6% from last year. That's a faster rate of growth than the fourth quarter of last year, the fourth quarter of the prior year. So it's accelerating during the years, and it's not people getting ahead of the tariff. This is going ahead of the tariffs thing. This is going all over in the economy, and that's because people are in relatively good shape. Now, there are certain segments of households, subprime borrowers can have access to credit, maybe delinquencies are higher. There's certain other areas. House price affordability is still tough because of interest rates. On the other hand, that market will straighten out at some point, and lack of supply in some cases. There's all those things, and so this isn't meant to be an unfeeling description. The answer is the consumers are spending money. That means the U.S. economy has an anchor to windward that very few economies have because that huge consumer base spends, and our customer base supports that across the board.
I want to switch over and ask you about Bank of America stock, which has done pretty well over the past year or so, either matched or exceeded the market performance. On the other hand, Warren Buffett has reduced his stake, and for investors out there, either hold the stock or considering buying the stock, is it a good time to buy, given that Warren Buffett has just reduced his stake?
Well, I think people had to look into what he did. He had a billion shares, and he reduced the stake, and they reduced it pretty quickly and then slowed down. And so you can see the disclosure on it. But the question is why was more a statement about the American economy. He completely got out of a lot of other positions. So he's been a great investor for us and been a great supporter of our company for a long time. And he's made a lot of money in stocks, as have the other shareholders. The other day, our stocks at buy, we're in it. We bought $4.5 billion last quarter of our own. So we're out there, using the excess capital.
Buybacks?
The excess capital to grow the company. We first use it to grow for our clients, support the client business. Second, to pay dividends, and third, to buy back stock. At the end of the day, in the first quarter, it's $4.5 billion of stock buyback because we're earning $30 billion round numbers, and the team's doing a great job, and that will happen. So I own a lot of our stock, and a lot of people own a lot of stock, and it's a good buy.
Last year, there were some concerns, Brian, about your held-to-maturity portfolio and that being a drag, being a big number and a drag, perhaps, on the stock's performance. Where does that stand right now, and is that still a concern?
The question was NII growth, and so if you look since last year's second quarter, we troughed in net interest income. That's the difference between our loans and our deposit that paid, and it continues to grow. So it bottomed out at 13.9, I think it was, and now it's last quarter is 14.6, and so it just grows, and we project it to be in the mid to high 15s by year end, another $1 billion of growth over 3 quarters. And so our growth rate is exceeding that. That's largely that fixed income portfolio running off that was meant to protect the NII in times of low rates is running off and being reinvested at higher rates. And so that repricing goes on every day, and we feel very comfortable with those assumptions. Even though the interest rate environment around us keeps shifting, we keep seeing our NII grow linked quarter faster than other people in the market, frankly.
What about the private credit business? Has about $2.5 billion. Is that money being taken away from your line of work then? Is that subtracting from your business?
Not to correct, I think you meant trillion.
Trillion, no, did I say billion?
Yes, you said billion.
Oh, I'm sorry, no, absolutely, $1.5 trillion to $2.5 trillion. You
So
wish it was $1.5 billion.
At the end of the day, we have two different jobs. A lot of us thinking as a balance sheet lender and stuff like that. That's a job, but the real job we have is actually serve clients. And if private capital is a better place to serve, we work with those firms to originate into their structures, their pools and stuff like that, because it spreads our risk and it serves the client well. And they're not interested in taking the client relationship away from us. They're interested in helping us grow the franchise. So at the end of the day, it's a competitor, there's no question. At the end of the day, there are parts of it that do deals that would be hard to do through the bank balance sheet in the regulated environment and with the capital requirements we have and the stress testing, all the things. But at the end of the day, we've had competitors for providing credit. The securities markets have been, in the consumer side, half the assets aren't in the banking system. And that's kind of what goes on as the efficiency of the capital markets get there. The interesting challenge for us is this gets into the middle market business, which has largely been untouched by the capital market side. And so it's the first time so we have to take it seriously as a potential competitor, but you also work with these companies, these firms that do it to generate the assets and work in a symbiotic relationship with them.
I want to ask you about analysts and doing calls with them. And what are they asking you about? What are they most concerned about right now?
You know, at the end of the day, they have the same questions you did to start this. Because we have a deep insight into the economy, they want to know what we've seen in the consumer business, what we're seeing in credit, what we're seeing in things like that. They want to know our views of where the policies in Washington go. And then at the end of the day, they want to know, are we growing customers? Are we growing clients in the commercial businesses and the business is growing and where we're making investments? And then a lot about technology, AI and the applications of technology. We put to work about $4 to $4.5 billion of new code every year. So a lot of investment going into the platforms. How are you going to display AI, use AI to your advantage? We have this thing called Erica, which has already been up and operating now for 5 years and stuff. So there's all this work, but they tend to ask about, they be almost bipolar, macro, what's going on in the world, and then very, how you're growing the company, and then they try to mesh the two together.
Right. Your PE, I think, on trailing 12 months, about 13.7, which is at the higher end. Market cap of what, 337 billion? I've got to make sure my B's and T's are right there. What are you doing to drive the stock forward?
The end of the day, we have to grow the earnings and have the good returns. So our returns on capital, tangible common equity, 13 to 14%, cost of funds, the cost of capital much lower than that. And then second, we got to grow. And so if you look at what we've done is the NII as troughed out last year in the second quarter, so a year ago, and you watch that come through, we're 60% NII, net interest income driven by our deposit franchise and then our loan franchise. As you've seen the deposits grow faster market, loans grow faster market, that's what we're doing to drive the earnings. Now the good news is Jim DeMar and the markets team have had a 12 quarters of consecutive year-over-year growth and continue to do well there. And the wealth management business, the fees have grown there, and they continue to do a great job. Lindsay and Hans and Eric Schimpf do a great job there. But and Katie Knox in the wealth and the private banking, those businesses grow. But at the end of the day, our earnings grow. Our job is to grow the earnings with the right returns, and we do a pretty good job of that. And then keep the risk right, because at the end of the day, we got to make sure it stick to the ribs growth. And so, when you go back and decipher that, our deposit franchise grows because we are a core transaction bank. We have a $950 billion plus of consumer deposits, a lion's share of which are transactional. And that is a great place to be with your 92% primary bank and household of American consumers. Then you go into the small business, and we have $250 billion of small business deposits and $30-40 billion of small business loans. We're big cash manager for small businesses, likewise the corporates. Those competencies are what we use to drive the business. But at the end of the day, what the investor looking at is, can you grow the earnings? Can you do it with the right risk? And can you get the returns while you're doing it? And that's what we focus on.
I want to ask you about another role that you are filling right now, which is Chancellor of Brown University, your alma mater. How are you looking to balance academic freedom there with demands or requests from the Trump administration?
At the end of the day, I think that Chris Paxson does a great job for us. She's been the president for this is the 13th year, and she does a great job, and she's balancing all that. And at the end of the day, this is the ebbs and flows of what goes on in society, and so we continue to work on inside the university what they call values and voice, which is how Chris has just pushed through a process with the faculty to sort of say, how do we maintain institutional neutrality and stuff like that. But I think, at the end of the day, these universities are great assets for the world. They really are. When you look at what goes on at our university system, whether the land-grant universities, the Ivy League, the other major private institutions, it is unbelievable what America can do there. And I got my eyes opened this by working in the group called the Council of Competitiveness, which was formed when Japan Inc. was going to take over the world in the post-Reagan era. And I got involved with it 10 years ago at the request of the chairman of the company, a guy named Chad Holliday. And you learned, it had the national labs, had the great, the land-grant universities and the other great major universities that did a lot of research. You had labor, had business, and you're learning about how that engine drives. And I think at the end of the day, America owes a debt to these universities, and these universities owe a debt to America to have been successful. And you see it. There's no one else that's close to it in the world, and that's why great leaders like Chris can help make it happen.
Switching back to the bank, you're doing a lot of sports sponsorships these days. One of the sponsors of the Masters. You're doing Boston Marathon, Chicago Marathon, FIFA. Yep. Cynical person says, really, you're spending the bank's money on that? Why is it important for the bank to do that?
Well, it's not only what we do, it's the way we do it. And so with our brand strength, which is high, our recognition is high, what we're trying to do is figure out ways to take these sports and continue to help develop them. So the Chicago Marathon is actually a Bank of America property. We actually run the marathon, and one of our employees, not run it on their legs, but actually runs it in terms of putting on the event. And in Boston, we picked up a sponsorship. So what we're trying to do there is saying, why are people running these marathons? Because they're the elite runners of the world. They're unbelievable athletes. So you can't, but you and I aren't going to make a big dent in a 2-hour marathon.
Oh, no.
And so the question is, why would you run it, or why would someone like you run it? And the answer is, that's the My Marathon campaign, saying we run it to help raise money for X cause, Y cause, Z cause. And so what we've been able to do is take these engines and make them an economic engine development for the local markets, $500 million of activity that weekend in Chicago as an example. But secondly, increase the charitable giving by putting a profile on why people run these marathons. Likewise with golf, we're doing the Masters, but we announced a thing called Golf With Us, which basically said for kids 6 to 18, they could sign up to a golf club, our golf club. They would then get a chance to play at muni courses, 2,000 plus muni courses across the country for $5. And so you're getting kids to play golf. So first he teaches them how to play, but this is more to get them on the courses. And we said we'd do 50,000 kids. We're through that already. We had announced another 25,000 kids. So in basically a month, we got 50,000 kids to sign up to a golf club to go play golf on muni courses, which gives the courses flow and potential proprietors. That's good for the local municipality. Exposes kids to the game of golf, but also exposes them just the discipline of playing and being around other kids. This is all good stuff. So what we don't do, just like we do with museums and things like that, it's all about how do you take these properties, so to speak, these major brands, partner with them, and then bring them out to the broader population in a way, frankly, our brand could do. FIFA, the same thing. We're all over the country, in the cities they're going to have the events in. We're obviously in all those cities. We're working with the local communities, how you can bring more people, and how you can work with kids, how you can work with fields that may need to be built in those communities, and all those things. So FIFA was a major commitment by our company, but when I talked to Johnny and the team, I said, we aren't going to do this just by putting our name out there. That doesn't do us any good. Our name's well known. We're going to do it by how we bring you to those local cities, and that's how we do through our local presidents and how we run the company.
And final question, Brian. You've been doing this for 15 years, CEO of the bank. I'm not even going to ask about succession anymore. I'm just going to ask you.
It was a great show. You should have.
Are you still having fun? And what are you getting out of the job?
Well, we have a lot of fun. I have a great team, and I'll go speak to a group of our teammates after this. And what you're trying to do, why you can have fun, is you can see what we can do for our clients, we can see what we can do for our communities, we can see what we can do for our shareholders, and importantly, we can see what we can do for our customers and clients. And so the way we run the company, every day you get up and you're excited about it. There's so much work we can do. There's so much market share to get. There's so much help we can give our teammates, whether it's the ones that lost their houses in a fire in California and how we help our clients through those issues, or the Western North Carolina floods. There's all these special moments we can help in, but what we're really doing is provide an opportunity for a person to join our company. And I've been at the company 30 plus years now. And 30 years later, I didn't come in as this, you could make this opportunity we can create for people, their families, and the communities and the clients. It's just second to none. That's what makes it fun. Otherwise, it would be tough because regulation and all this stuff at the moment. What makes it fun is just what you can do to help people recognize the opportunity they want to recognize.
Brian Moynihan, CEO of Bank of America, thank you so much for joining us.
Thank you.
This is at Barron's. I'm Andy Serwer. We'll catch you next time.